But talking about the fundamentals of the market, we have Ashi Anand joining us to talk to us about just that. Ashi, let's begin by asking these latest IPOs that we have seen. Have you tracked Tata Technologies?
Oh, yes, we definitely have. And it's clearly been one of the most attractively subscribed IPOs in the market we've ever seen. So clearly a lot of interest in that particular company.
Okay, sorry, Ashi, please go ahead with your answer.
Yeah, sure. No. So Tata Technologies clearly is a very interesting tech company. Now, the slight problem is, I think, post listing, you're going to see it trade at kind of premium valuations. The overall scope for kind of growth, given the slowing global economy, is a bit impacted. So while Tata Technologies clearly is a very attractive company, I think as a stock, we just need to see where it settles post listing, and we can kind of take a call from it post there.
Ashi, you wouldn't have any interest in the insurance space, would you?
No, we actually very much do. So we have a strategy that we call concentrated micro trends, where we're really focusing on those parts of the market where we're seeing value creation happening. So just a micro trend is within a larger sectoral or larger thematic trend. What are many kind of trends that you're witnessing? So say, for example, in BFSI, we see these banking franchises as being one micro trend, asset quality normalization being another micro trend. We are very actively looking at the capital markets or the financialization of savings microtrend, where you are seeing a shift in savings profile of the Indian saver away from traditional fixed deposit, physical real estate and gold towards financial securities. Now, this can benefit a broker, a demat company, a mutual fund, or insurance. I think this entire space looks very attractive over the coming decade as kind of India as an economy grows, as discretionary consumption increases, as incomes move up, you are going to see a greater and greater shift towards kind of financial securities. Now, within this kind of insurance, does clearly look quite attractive, and across kind of insurance segments, be it life, auto, health, etc., penetration rates in India are substantially lower than what you are seeing globally. I think this is especially true in life and in health. And it really gives a very large legroom for growth. You have kind of space for growth just in terms of market share, in terms of the market overall increasing in size, but there's also a larger value migration at some level that you're seeing away from PSUs towards private sector companies here, which is also helping boost growth rates. So it is definitely a space we are looking at and that we do like.
She wanted to get your sense in. I mean, realty is pegged to be a decadal story, right? Along with, of course, infrastructure, especially ahead of the elections. What's the best way now, after the rally, which has already played out, to cash in on this surge?
I'm sorry, did you ask me the question?
Yes, Ashi, to you.
Hi, sorry, I didn't hear my name. Yeah, so I think we're still relatively in early stages of this move. What you have, it's important to understand that real estate, and I have indicated this earlier, is a kind of, you had 2010 to 2020 was a lost decade. You're really seeing a lot of kind of pent up demand. Affordability has improved. The demand or the desire to own a home is actually only just increased post COVID. I think you're seeing early stages of the cycle. You're still having inventory being cleared out. This real estate trend that you're seeing, especially in residential, is something which, according to us, is still a multi-year story, and you're still early stages of that cycle. Infrastructure, you're really seeing a government which is very clearly intent in terms of improving the infrastructure in India across roads, ports, etc. Now, all of this is all very positive for kind of cement demand. Another very important segment is actually affordable housing. We may not see these numbers in listed peers, but there is in tier 2, tier 3 towns, there is a lot of building happening in terms of single homes, etc., which is a big component of kind of cement demand. So I think the overall outlook for a lot of these spaces, real estate, cement, manufacturing, all of this is looking quite kind of rosy. Stocks have moved up. I think they are reflecting some of this positivity. But given the fact that it is a multi-year cycle, which is possibly just the first couple of years into, we probably see more upsides from here.
That's the take coming in on the real estate sector. sector. But
stock which is holding out very well and smartly has been Trent. If you can just bring up the intraday graph, because there too you are seeing gains of about 3 to 4%. That's what the stock is clocking. And Ashi, you know, for some of these stocks, I think the rationale of what the PE looks like, or, you know, what multiple is a fair multiple, does not really hold true. And case in point being Trent.
So I'm actually not a big buy into that. It's not that PE doesn't hold true. It is today's PE may not be reflective of the value of that particular company. So if you look at Trent Trent is a good example, right? They've just been brilliant in terms of the execution on the retail space. Zudio as a format has also been doing extremely well for them. What happens is for certain kind of companies, especially when you are growing, you're setting up new stores, those stores will be loss making initially. So growth is costing in terms of near-term profits. And if you're just looking at today's profits and trying to give a multiple on that, the faster you are growing, the larger the negative impact of that initial near-term growth. And that kind of inflates the P, making it look very high. So it's not that Ps are not relevant. If you are looking at some of these companies which are growing rapidly, which have high near-term kind of investments which are associated with them, you need to make adjustments to these to understand some kind of true intrinsic P, understanding earnings a few years down the line and kind of valuing it based on that. So I think valuations and multiples are always important. I am not of the view that a great company can trade at any kind of value, right? There always has to be a combination between a balance between growth, quality, and value. It's just that today's price earnings, right, may not be really reflective. And I think this holds true absolutely in our digital portfolio, right? These companies don't even make profits, yet we are looking at profits down the road and being able to value that. But you still always do have to look at valuation multiples.
okay, interesting there. Ashi, we'll let you go on that note. Thank you so much for making time and speaking with us. But